Welcome back to Investing You, everybody. Now that I've showed you how to register and sign up onto the investing platform EasyEquities, and now that I've given my 2 cents on Tesla and I've told you what I think about Tesla and their future, if you haven't watched it, go watch that video over here. Otherwise, stick around and we'll be going over what an ETF is, how it's different from a mutual fund, what to look at when choosing an ETF, and also where to find it on EasyEquities. Stick around and enjoy the video. Before we get down and busy into the ETF, please hit the like and the subscribe down and show some love for Investing You. So, what is an ETF? The best way I can explain to you an ETF, by definition, is it's a collection of things. It's a collection of stocks, it's a collection of stuff you can buy and invest in. Think about it like a shopping bag. When you go shopping and you put a lot of stuff into that bag together is an ETF. Now, I don't know about you, but when I grew up, when I went shopping with my mom, all the stuff of the same type had to be collected together, had to be grouped together. Like all the dairy stuff, all the cold meat stuff, all the dry, all the cosmetic stuff. Otherwise, it'd be chaos. Trust me. So an ETF is very similar to that. ETFs commonly are all the stuff, all the stocks inside the ETF has something linking each other to them. They might not be exactly the same, but they might be in the same industry. So let's say you've got a shopping bag full of dairy products. You've got milk, you've got yogurt, you've got cheese, you've got butter. They're not the same product, but they're of the same type. So that means, let's say butter starts doing very bad on the market and butter goes down, but people are still buying milk. So the milk doing good and the butter doing bad, they're evening each other out. Now it's exactly the same with an ETF. So you've got an ETF, let's say you've got an ETF in tech, and the most common one is probably the NASDAQ 100. So you've got a lot of tech stocks, and the top ones are doing great and that's growing, and then the ones maybe at the bottom aren't doing too great and they're struggling, but overall your ETF still has a good growth probability. An ETF is just a collection of stocks. You do get ETFs out there that are way out there. You get ETFs that are very well spaced. They've got some healthcare stocks, some tech stocks, maybe some retail stocks in there. So it's very diversified, and ETFs are one of the best ways to diversify your portfolio. And one of the great things about ETFs and why it's becoming so popular is ETFs have very low expense ratios. So that means you pay very little in commission fees and admin fees and brokerage fees to actually invest into those ETFs. Yeah, so ETFs does not only have to include stocks, it can include bonds, it can include cash, ETNs, a lot of stuff. And that's the great thing. That's why I think about it as a shopping bag. You can put a lot of different stuff in there, and that whole bag together is your value of your ETF. In an ETF, you can sometimes have more than one thing. You can have 2 cheeses and 1 milk, or you can have 4 cheeses and 1 milk. And that's the same. You can have 4 of Tesla and 1 of Apple in there. So it's all balanced and it's a ratio, but it's all in this beautiful collection of things. You have to have a diversified portfolio. And an ETF is a great way for a starting investor to get your portfolio diversified from the get-go, because you're investing into one thing that immediately diversifies your entire portfolio. An ETF is also a lot more tax efficient, because normally if you sell one of your stocks, you have to pay tax on those capital gains. But now if stocks get sold into in an ETF, you as an ETF holder don't have to pay that tax. That is for the company managing that ETF that has to pay that tax. And one of the things I also like a lot about ETFs, it gives you access into stocks that you might not have had access to before. Let's say I want to buy shares in Samsung, for instance, and Samsung is an Asian stock, and I don't have access to the Asian stock market. But now, if I buy an ETF that has stock, that has shares in Samsung, I technically have shares, well, I have stake in Samsung. And that's the great part about it. You can get access to so many things. And there's a lot of ETFs out there. You get the most common one that everyone probably knows is the S&P 500, which is pretty much just the largest 500 companies listed in America. And that gives you such a great diversification, because it includes a variety of sectors And if one sector does bad, that doesn't mean the other sector is doing horrible. So there's a great balance, and a lot of the times the S&P 500 has been outperforming a lot of individual stockbrokers. And you guys know I love the ARK Invest ETF because it's just the innovation tech, it's the future, focusing on automation, they're focusing on 3D printing, they've got Tesla, and so you're probably wondering, how does an ETF then get managed? Well, if you've heard about a mutual fund is pretty much exactly like an ETF. It also holds a collection of stuff. The only difference is, for a mutual fund, you have a broker that manages that, and they get paid quite a bit to constantly trade stocks, sell and buy and manage and look at what that mutual fund holds. And that's why mutual funds have a lot more admin and brokerage fees towards that. But now ETFs came along and they approached this passive approach where you have this S&P 500, it's a list of all the companies, and there's a certain amount bought into those companies and it's just left. And every 6 months per se, or every 3 months, it's re-looked at and just made sure that it follows the benchmark. Oh, yes, the ETF does put a bit more responsibility into your hands, because you need to make sure you constantly check what that industry that you bought your ETF in is doing, because normally a mutual fund manager would do that for you. But the big difference between an ETF and a mutual fund is a mutual fund gets traded after the market closes. So their value gets decided on after the market closed. When ETF gets traded throughout the day, it's like a normal stock. You can buy, you can sell. So that means you've got better liquidity, meaning you can easier sell an ETF share or you can easier buy one. Whereas a mutual fund is a lot less transparent than an ETF, because an ETF shares and holdings have to be made public and you can easily sell in and buy them. Where a mutual fund, you have to wait for your manager to decide what stocks he's going to buy and sell, and probably only find out 2 days later. Mutual funds normally have an exit load amount. So that means when you draw out all your money, you have to pay 1, 2, 10%, whatever, of that money that you draw out to the fund manager. ETFs aren't like that. ETFs, if you pull out your money, you just pay for the admin fees or for the transaction costs, and that's it, and it's minimal. What are some of the stuff you want to look out for when choosing an ETF? The first thing I would definitely tell you to look at if it's an active or passively managed ETF. Now, most ETFs will be passively managed, meaning they are reevaluated maybe every 6 months or so, but they're not constantly being traded and sold. You do get some ETFs that are actively managed, and yes, it might mean that sometimes they do cost a bit more, but it is still a lot cheaper than a mutual fund. You guys know one of the active ETFs that I love is the ARK Investing ETF, and I've looked at a lot of ETFs, and the ARK Investing ETF is a lot cheaper when it comes to your charges compared to some other passively managed ETFs out there. Definitely, you have to look at, is your ETF doing income distribution? What's income distribution? It's dividends. You want those dividends out. Now, what normally will happen if an ETF does not do income distribution, that means all the dividends they get from those companies, those stocks that they hold, they'll reinvest for you. Me personally, I love it when ETFs pay out that distribution income so that I can decide what to do with it. So I decide, do I want to put it back into this ETF, or maybe I want to put it into somewhere else, maybe a stock or something. Then after you've looked at that, go look at the holdings, go look at what this ETF holds, go look at the description of the ETF. Is it an ETF that invests in innovation tech? Is it an ETF that invests in dividend growing stock? You can have 2 different companies tracking the same index. For instance, you can have a One Invest and you can have a Satrix top 40 ETF. So what that means is it tracks the top 40 companies in South Africa. But now you've got 2 different companies. They shouldn't differ too much, but still go look at how that manager is tracking that index. Are they doing good? What's better performance? But the big make or break comes in with the fees that they charge on the ETFs. And that's the big thing I want you to look at. Look at the ETF's fact sheet. Google the name and add on fact sheet, and you can get the PDF. Look at the total expense ratio, the TER. That is the important thing you want to look at, because that shows you how much you will be paying annually for that manager to manage your ETF. But now remember, your total expense ratio, that gets deducted yearly. But that doesn't mean you now have to go and do an ETF payment towards this company. All they do is, at the end of the year, they'll adjust your net asset value, meaning the value of your growth, and they'll adjust it to that so it automatically takes it into account. Let's say your ETF has grown 8% and the expense ratio is 1%. That just means that your value at the end of the year will have grown by 7%. So to find the ETFs on EasyEquities, all you do is you log in, you go to Invest Now section, whether it's under the ZAR, the tax-free savings account, or the USD part, and you go down to the categories and you click on ETFs. And then what you want to do is you want to click on the 96 drop down so you can see all of them, and start going through. Click on one, look at its performance, and then at the bottom there you can find the fact sheet a lot of the times. And don't stress if you don't see the fact sheet there, just go Google it. You can find all of these. They have to be publicly available, so don't stress about it. Don't stress if you haven't joined up to EasyEquities, or if you're using a different investing platform, that's great. But if you haven't joined up to EasyEquities and you need an investing platform, go click on this link and go watch the video where I'll show you how to do it. If you're a starting investor, I would definitely say ETFs are one of the best places to start, because I mean, if you're investing that 50 Rand that we spoke about, you can't go buy 10 different stocks now with that 50 Rand to have a diversified portfolio. You're going to have minute pieces of that stock. So rather buy an ETF, start growing your money, start getting those dividends in, and as you make your money, then you can split. Yeah guys, so that's pretty much ETFs at the base. If you want to look at South African ETFs, a few I would say for you to go look at is the Signia 4th Industrial Revolution ETF, the Satrix Top 40, the Satrix MSCI China one, which looks at all the China companies. I'll definitely be going through some ETFs I like in future, but stick around for my future videos for that. And thanks again for listening to me, guys. Hope you enjoyed this. And please, if you have any comments, if you have any video suggestions, drop them down in the comments box, and hit the like, hit the subscribe again, please, and tell your friends to watch this video. And I'm so glad that you guys are sticking around with me on this journey. We are going to grow our money, we're going to be financial freedom, and it's going to be great.